Hey everyone, welcome back to Invest with Corey. If it's your first time stopping in, be sure to subscribe, tap that bell. I greatly appreciate it. You're going to learn something here that's going to be very helpful. In fact, my goal is to teach you a lot of things that are going to be extremely helpful, kind of guide you and coach you into growing your portfolio. So in this video, I want to show you how investing in stocks doesn't have to be simple and boring. You can make a lot of money just holding on to stocks by doing one specific thing that is going to generate you so much extra money. The plain old boring stock investor buys a stock and then just lets it sit there, and he waits for time to play out for the stock to go up slowly but surely over time. 3, 4, 5, 10 years, however long it takes. However, you can do one specific thing to make extra money on top. And even better than that, if you have a specific stock in your portfolio and it starts to go down a little bit and you're losing money, this specific strategy will help alleviate and offset some of those losses. Now, I'm not a financial advisor, and I'm just trying to help you with different strategies and tools so this way you can grow your portfolio. But it's up to you to decide where and how you'd like to invest your money. Everybody's risk tolerances are different. Remember, risk management is key. So let's say you have Palantir and you purchased Palantir at $24, but now Palantir's at $23. You've lost $100 on those 100 shares. However, if you start selling covered calls on Palantir, and let's say you've sold 2 or 3 weeks in a row and you've collected $60 in premium, you're only out $40. Because if you continue to sell covered calls on the stock that you currently own, even when it goes down, you're losing very little, if any money at all. In fact, there's also times when the stock will go down, you're still in the profit. Currently, I have SoundHound AI. I have 100 shares. I got in at $10.04, so it was $1,004 for 100 shares, and now it's down to $6.20. Or $6.10, which means I've lost almost $400. However, I sold a $50 put that expired worthless. Then after I collected the shares and purchased them, I sold covered calls for 2 weeks straight, and I've continued to roll it every 3 or 4 days, which is really crazy, but I've been working the volatility of the market. I've collected over $200, which means I'm not out $400. I'm only out around $170 because I also sold the $50 put. The best way to get in a stock is the wheel strategy. You sell puts to get in. My previous video explains that. I'll put a link right there to watch it on the screen. Be sure to click that and check it out if you haven't already. Once you're in the stock, you sell covered calls to get out of the stock. If you do not want to get out and you want to hold long-term, whether it be for dividends or just long-term growth, then you're going to want to sell way out of the money calls. However, if your goal is to get in stocks, then sell calls to get out while collecting premium in between, which is what the wheel strategy is, then you sell covered calls that are not too far out of the money. For example, on Palantir being right now at $24.40, you might want to sell a $25 call. This way you get the premium of $20 to $30 plus the $60 extra dollars if you get assigned and your shares get called away from you. Plus, not to mention, you also sold the put to get in. So as an example, if Palantir is at $24.50 and you sell a $24 put and then the stock price falls below by the end of the week, you get assigned, you get put the shares at $24. You have a premium that you collected, let's say around $20. Now you sell covered calls at $25. Let's say it takes 3 weeks for the stock to hit 25. You collect premium 3 weeks in a row at $20. There's 60 plus the original 23. That's $83. We'll just say 85 to make it easier for this video. Then you get assigned. The shares are called away from you. You sold them for 25, but you got in at 24. You made $100 plus the 85 in premium for the put and the covered calls. So you've made $185 in 1 month on $2,400, or actually $2,300. So that's about an 8% return in 1 month. And there can be even more profit to be made depending on implied volatility. That is very safe income because you're getting paid to enter a stock you want. And then if the price goes down, you didn't really lose the money because the price will eventually recover, and you can keep selling covered calls to get out at a profit while collecting premium in the middle. So in the grand scheme of things, it's very low risk compared to just buying outright calls and puts, because when they expire weekly, you can lose all of the premium you paid. Let me give you an example here and show you SoundHound, what I've done there, and show you how to sell covered calls. It's so awesome because I'm like collecting people's money to enter a stock. I'm getting paid to buy stocks with other people's money by selling puts. It's like I'm getting free stocks. Oh, don't mind if I do. And then after that, I got the stock, and then I'm selling covered calls saying, hey, the price is never going to go here, but if it does, I'll take your money and then sell it at a higher premium. You know what I'm saying? Oh, Thanks. I'll take that too. I'm taking your money to get in, taking your money to get out, selling it for more than I bought it for, and I'm repeating the process. So here we are on SoundHound. You see I am down $398, but that is not the case, because if we go down here, you will see that I actually sold a $50 put. It expired worthless. Then I sold a $60 call option. Then I rolled this option by buying the old contract for 48, selling the new one for 83, and collecting 35 more. So 35 plus 60 is 95. Then I rolled it again and collected another 60, which is 155. Then I rolled it again. Because of the volatility, I was able to roll it again and now roll it down to a $6 call and collected another $92, but I had to buy the old contract for $12.80. Plus 95 is 175, plus 50 is 225. So if you look at how much I've lost on SoundHound, you'll see I'm out 398 minus 225. So I'm only out $173 at this point. And when this contract expires next week, I'm going to sell another one. So in about a month from now, even at this price, I'm at break even, and I'll just keep selling covered calls, which means I will make that money back. And then as SoundHound goes up, I just keep selling those calls and can hold long term. I can end up just letting myself get assigned at $7 or $8 or $9 and then getting out at a profit, because at that point, if I can get out at $8, $9 or $10 plus all the money I've made in between, I'll end up making $500 in a month or two on a $1,000 investment, which is a 50% return in 2 months. If you do this throughout the year and you add that up, you could easily make 100 to 200% per year, depending on the volatility of the stock. On the $1,000 that I put into SoundHound, I've already made $225 by next week. Right there is a 20% return in 2 weeks. I keep doing that. In 2 months, that's 40%. In 4 months, that's 80%. That's 240% a year. And you can do this on every stock. Let me show you exactly how to set up a covered call. I already have a covered call on Rivian Automotive. However, you just go to Trade Rivian if you, let's say, had these shares, and you're going to pick an expiration date. If you're watching this in the future, it does not matter, because it's the same strategy either way. What we're going to do is we're going to click sell and then click call, sell calls, and then we're going to pick a strike price that we want to set. So right now, Rivian's at $10.84. We're going to pull up Trading View and we're going to go over to Rivian. And with the chart, we can see that Rivian's got a pretty solid foundation at $10 and a pretty decent one at 11 as well. It's pretty much bouncing around the mid to high 10s, right around 11. And it's got a lot of resistance right here at $13.50, but you can see how much consolidation is happening below $11.70 to $12. So if we zoom all the way here, take a closer look, you see what's going on and how long this is. We're going back a week, 2 weeks. There is a chance that Rivian could spike back up to $13, $14, but it's highly unlikely. If we're going to be safe, we could get away with $12 calls if we're going a week out, maybe even $11.50. If we're going a month out, I would highly recommend doing $12.50 or $13. And you get into the situation where the stock price goes in the money. And what I mean by in the money is when the stock price is now higher than your covered call, it's now in the money. Meaning if you had sold a covered call right here at, say, $10.50, and the stock price is up here, you can see stock price right there. Your covered call is $10.50, but the stock price is $10.84. This $10.50 call is in the money. You can be assigned and your shares can be called away from you, and you will sell them at $10.50, even though the stock price is at $10.84. So if you end up selling a covered call 1 month out at $11.50, and just, let's say, Rivian comes up, resists, and then breaks it, and you're only 2 weeks in, that covered call that you sold for, say, $20 at this point is now worth about $60. So now, in order to not pay a debit to purchase that call contract back, you want to now roll it out further. So instead of expiring, let's say, on March 28th right here, you're going to have to roll it to $12 for April 12th to give you more time. And what you're going to have to do is roll out and up far enough so that you collect a little bit more credit. For example, I will show you how to do that. When you're setting up a covered call, you got to select your strike price on a covered call first. The delta here is 14. So that's highly unlikely. Like I was saying, 12 is pretty good. So you select that. You'll see you're going to collect $6. Continue. You'll select the price that you want and review order and go on. You collect the credit. It's available in your brokerage account immediately. You could do whatever you want with it. And I already have one. You can see right here, $11.50 call that I've already sold. Let me show you how to roll that and what it looks like when you have a covered call. This is the covered call that I sold. The average credit's $42. and the current price is $13. I'm up $29 or 69%, and this expires next week. So you can see I've already made most of my money, and what happens is as time goes on, the call option decays. It becomes worth less money. I'm also going to show you details on how to roll contracts in the future as well, but I will show you right here. You click roll. You're basically just buying to close the contract you sold, a debit, and then you're selling to open a new contract in the future, and maybe possibly at a higher or a lower strike price. So I'm going to roll. You can see right here my covered call, $11.50, expiring March 28th next week. We're going to buy to close it at 13. I'm going to go out 2 extra weeks to April 12th. And since the stock price is at $10.84, I might go down to $11 to collect more premium. And you can see that's $64. So by rolling down a little bit and out 2 weeks, I will collect a net credit of $51. Now, if Rivian goes above $11 in the near future, then I'll just roll out 2 more weeks and back up to $11.50 and collect another credit. You can continue to roll out and up, out and down, or you can roll down and closer to the expiration. So if I had a June contract for say $12, I could roll it back to April, which is closer, and down to $10, and it would be about the same, maybe even a slight credit. If you know how to roll options properly, you can consistently collect money. I don't mind if I do. I'll take your money. It's just money. I'm just going to keep collecting it. Let's just say we think Rivian is going to keep going down. We're a little bearish on Rivian. We'll go out 2 weeks. Click $11, we collect a $51 credit. Let's say that now we get to April 12th and Rivian goes up to 11 and we need to roll out more. We can just go out here to maybe May 17th. We'll go up to a $12.50, and then look at this. If we roll up to $12.50, it gives us $1 more breathing room and an extra month, and we collect $81 more. And you just keep collecting premium. And selling covered calls is so safe, because the worst that can happen is it expires in the money. You get assigned, your shares are called away. That's what they're called, calls. And you sell the stock at the strike price you chose. You get to choose the price of your put that you enter the stock, and you get to choose the price of your call for you to sell and exit the stock. You're in pretty much full control of how you enter and exit and which stock you choose. So as long as you choose high quality stocks, you can't really lose, can you? Because you're entering the stock you want, making a profit, and along the way, you're collecting lots of juicy premium. Hey, give me some more money for these stocks that I own. Yeah, that'll be $51 more. I mean, the price is never going to $11.50. Oh, did I say that out loud? Mean to. Sure, it's going to $11.50. Sure. But that's going to do it for today's video. I'm hoping you guys enjoyed it. Be sure to comment below if you have any questions or comments related to the video, as I respond to all of them, as I truly want to help you guys out, to learn how to do this and coach you on proper strategies and risk management and how to grow your wealth and live a better life. Be sure to subscribe and tap the bell if you guys want to know when I go live or post new content. Really helps the channel if you give me a thumbs up and share it with anyone you think that might enjoy it. I'll catch you on the next upload or live stream. Take care of yourselves, and until then, let's grow our wealth together and live a better life. Take care, guys.